Hi, my name is Reed Silverne. The name of the show is Fed Pride. Reason it's called Fed Pride is because I'm a federal worker and proud of it. I'm going to do the traditional spin of the earth, and then I'm going to see if I can get North America back up. There we go. All right. I may sound like I'm really suffering over here, and that's because I am. I've had a credible allergy attack for the last 3 days. I haven't been able to sleep. I've been coughing up a storm, and if I do cough, I'll try to block it with this. But I can't guarantee that I won't cough and be all disgusting on here. So basically, what we are is live to tape. For me, it's Friday, the 28th of March. For you, it's probably the 30th of March, Sunday, or you could be watching on Tuesday when there's another showing on the other channel. So what you'll be seeing will be all the mistakes and all the coughing and all the problems that I'm having here on Friday, which will be live to tape. And just to prove how live everything is, I lost North America over here over my right shoulder. And now I am about to take a call from Annie Mae. There she is. Let me get rid of the title over here. See if I can get rid of it. That's not working either. Okay. Maybe we can lift Annie Mae up. That's not working either. Okay. All right. Okay, there we go. All right. That is excellent. And Annie Mae seems to be frozen over here. Annie Mae appears to be on the show. Let's see if we can see what she has to say.
Hi, it's Annie Mae here. I just wanted to call in and see how you were. I heard that you were sick.
Yeah, Annie Mae, I've really been coughing. I've just had terrible allergy attack. The Mo count's the highest in recent history, and it's just driving me up the wall.
Are you calling in?
No.
Are you going to do your show?
I'm going to try.
Remember, the show must go on.
Yeah, that's true. Even though I'm squeaking a little bit, I intend to do the show, and I try to be a trooper.
What's your show about today?
My show is going to be about what Bernanke's doing, the Federal Reserve Chief, and the parallels to the Great Depression of a lot of the big problems we've been having.
Well, we won't talk about that. Just do your show.
Okay.
Break a leg.
All right.
And let's do lunch.
Okay.
I'll see you.
Bye.
Bye. Ta-ta.
Ta-ta. Okay. That was Annie Mae over here. And I'm going to minimize over here. And we'll get on with it. Okay. So today the show is going to be, Annie Mae has been encouraging me to do more tabloid or public interest or personal interest type stories, not this, deep-seated economics and foreign policy and all that stuff. Been kind of passively resisting. The good news is that she's had some suggestions which I think have really improved the show. And her segment, she always comes in for a pep talk every single week, and I hope everybody enjoys it because I certainly do. And I need a woman's touch in the whole thing, and also somebody who's just a little bit more well-trained in media, knows what she's talking about. She's, in with all the Hollywood people. She calls in from Malibu. You can see the beach behind her. So she's really done a lot of good, I think, for me so far. And we'll see. We'll see how it all works out. Well, we've had a series of economic problems for the last probably about 8-9 months. It started during the summer of 2007, but really this has been brewing for the last couple of years. Basically, what we're in is a credit crunch, and a credit crunch that's driven by the subprime mortgage problem. Now, I say it's driven by, but really, I warned you, But really, that's more of a symptom than the problem. And the problem has been caused by some of the solutions to the last series of crises. Basically, in 1990s, there was an incredible boom in technology. Technology stocks went through the roof. Energy was very, very low. Price of oil was very, very low. There was a wonderful economy, and it just started booming and booming and booming. Stock market, basically, the S&P went from like 600 to 1,500. The S&P reflects all the stocks, including the NASDAQ. NASDAQ went from, I don't know what it was, well under 1,000, all the way to 5,000. And then the bubble burst. And one of the reasons the bubble burst was because there were certain companies like Enron that were creating phony financial instruments, phony markets in electricity, internet connections, and so on and so forth that really didn't exist. They were manipulating these, and they were doing basically a situation where they were taking their liabilities off the books, putting liabilities in partnerships, conning these big private equity and investment firms and retirement funds into funding these liabilities. Why anybody would buy a partnership with only debts and no assets? Well, the reason is they said, we will turn this into another one, and we will guarantee that you'll double your money. One of those clients demanded that they actually give them that money in cash and not another partnership, and that began the collapse of Enron. But from Enron, the internet collapse occurred about simultaneously, and the solution to the whole problem was improving the way companies deal with their financial statements. So we had a tremendous improvement in the quality of financial statements from companies. We've had a tremendous improvement, especially from the Depression, in the way banks run their business. However, what we've had are a series of new types of companies and new financial instruments which were unregulated and uncontrolled and have led to these kind of problems. What were they? Well, one of them is called CDOs, collateralized debt operations. I'm not sure what the O stands for. I was supposed to look that up last week, or 2 weeks ago, and I didn't. It's collateralized debt obligations, CDOs. But what they are stocks that the basis of the value of the stock is the value of a bunch of mortgages within the stock. And what happened was, in order to solve the tremendous loss of value, the potential for a terrible recession in late 1990s, from 1999 to 2002, the Federal Reserve dropped interest rates, short-term interest rates, interbank interest rates, from in the fives all the way down to 1%. The result was there was a tremendous, and I repeat, tremendous margin that the banks were getting and the mortgage brokers were getting to put out mortgages. So people could get 5.25%, 5.5%, sometimes 6% fixed rate mortgages, and the cost of the money was only 1%. So this was a tremendous amount. Then 2003, 2004, 2005, things got better in the economy, and the Federal Reserve started raising the interest rates back to something near normal. And the result was that margin started to narrow. And in return, a normal mortgage broker would say, well, my margin is not as big, I'm not making as much money, I'm going to have to do different things if I'm going to make that up. But instead, what they did is they pushed mortgages and riskier and riskier mortgages in order to make up with volume what they lost with margin. So now the difference in the margin is maybe 1%. So they're offering a 7% mortgage, paying 5 or 6%. But what they were doing is they were telling the people, we'll give you a 5%, actually below the rate mortgage. And then, excuse me, we'll go back up later and we'll adjust your mortgage rate up. So the result was there was a tremendous increase in the number of ARMs. The value of property was just skyrocketing because basically these mortgage brokers would give you a mortgage to anybody no matter what the risk. Why did they do that? Well, the reason they did that is because of something new called CDOs. And what CDOs are collateralized debt obligations, as I said before. But they're really stocks that are backed by the value of a series of mortgages. So what they would do is they would take a $100 million or $1 billion worth of mortgages. They'd package it together. They'd go to Moody's or one of the rating organizations. They'd say, this is AAA rated. And then they would sell these CDOs, which are really packages of the mortgages, to investors. And who were these investors? Well, a normal bank, a normal company, retirement fund, in good faith, would never buy something that they didn't understand what was in it. However, these rating organizations like Moody's and S&P were giving these things were just basically piles of subprime, worthless mortgages that large portions of which were bound to default, and they were just throwing them into the mix and then handing them out. A lot of it is like, I was a bank teller at one time, and when you're a bank teller, the companies will come in and they'll give you packages of money, like $100 bill, $101 bills in a packet that's all sealed up. And in that $100 bills are 4 or 5 counterfeits. Well, basically, unless you look at every single bill, you don't know what you're getting. You're just getting the package that says $100 on the top. Well, that's basically what happened. Now, there's been a change in the banks themselves are forced to have leverage ratios, capital to asset ratios. They have to follow rules, so on and so forth. But there's a bunch of new players in town. One of those are what they call private equity firms. It's like Carlyle, which is owned, controlled by George Bush, the president's dad. There's a bunch of those on the table. And then there's these investment banks. Well, most investment banks are, these big giant companies that buy and sell entire whole companies. But a lot of the investment banks of now either were bought by or they are basically stockbrokers. So these stockbrokers were basically buying up these CDOs, selling them to their customers, and so on and so forth. And that's what Bear Stearns was, that just almost went under. Meanwhile, these banks in Europe, they were also buying the CDOs. So there was a bank in France, Paribas, might have been Spain, I think it's France. It practically went under. Another one in Germany practically went under. And that was last year when the crisis first started. Now the crisis has got out of control. Why? Because credit is shrinking. Now, why does credit shrink? And this is something I had to look up over here, and that's because a normal bank, this is not a private equity firm or a venture capital company or a sovereign wealth fund. It's controlled by the government of Dubai. Normal bank, basically, excuse me, if a bank has $1 billion in capital, and we'll keep it simple, because there's really Tier 1 capital, Tier 2 capital, Tier 3 capital, and so on and so forth. But if they have $1 billion in Tier 1 capital, that is actual, real, hard money that has been invested by their initial investors. $1 billion in real money. Basically, they can use that to leverage what is called in the banking industry an asset, which everybody else calls a loan. So basically, they can give out $20 billion in loans if they have $1 billion in absolutely the highest level of capital. So that's a 5% leverage ratio. Now, what happens if the company loses $900 million of that $1 billion in capital? Well, now they're capitalized at only $100 million, in which case they can only hand out loans of $2 billion instead of $20 billion. What happens to the other $18 billion? Well, that's unclear. But what is clear is they can't loan any more money. And that has basically what has happened with these loan losses. The large banks, the large capital equity funds they were suckers. They were stupid. They basically took billions and billions of dollars in these CDOs, sold them and kept them in many cases, and they've lost money. What's the value of them? It's hard to say, because who the heck wants to buy something that probably is full of mortgages of people that were deadbeats to start out with, put up none of their own money for their house, that only lose the house and nothing else if they're foreclosed upon, and there's an unknown amount of these bad loans in every CDO. And I know, my broker came to me with something that was very, very similar. It was a right or some kind of crazy thing at 9%. Like a sucker, I bought that too. Because I've just about been in every downturn scam, owned Enron stock, and who knows what else. However, now I'm trying to get smart after the fact. So here we have these CDOs, and people a lot smarter than me, and I didn't lose very much in it, have bought billions and billions of dollars. Now it's come to roost. It's not summer of 2007. It's now spring of 2008. It's 9 months later, and somebody's got to show these losses on the balance sheets. Once they're shown on the balance sheets, then this leverage ratio comes in, and they can't loan out as much money. Now, this is very, very similar to what happened after the stock collapse in 1929. Everybody's heard about the Great Depression. Everybody's heard about Black Tuesday, I believe, or Black Friday. That there was a day when the stock market collapsed, and that started the Great Depression, and people jumped out of windows. But basically, what really started the Great Depression started the next year. And what happened was the Bank of the United States, which was in the Bronx in New York City, which wasn't the real Bank of the United States, not the Federal Reserve or anything like that, but the original name of what was the Federal Reserve in the early history of America was called the Bank of the United States. This bank collapsed at the tail end of 1930, about a year after, between October and December of 1930, about a year after the great stock collapse. And what happened was, rumor came out that they were broke. 2,500 depositors took out $2 million in one day, and then there were riots in front of the building to the point where the authorities shut it down. This impacted Europe, and a few months later, the Credit and Anstalt Bank in Austria. Austria seems like, it looks like a little country, but in fact it had been, it controlled all the countries around it at one point. And the banks there in Vienna still kind of were the dominator of the economies of these other little countries around there. They collapsed in 1931, about 3 months after. Then there was a series of bank collapses in England and France and Germany and so on and so forth. And credit started to contract. The Federal Reserve didn't put any money in to the monetary base. So, boom, things contracted and contracted. Companies couldn't pay. They closed their doors, laid off their workers. People couldn't buy. More companies collapsed, and so on and so forth. The final result was 25% unemployment in America, and in Europe it was much higher than that, 30, 35, 40. And what is the unemployment when the employees can't get enough to support themselves too, the people who are still employed? So there was complete and total disarray in all the economies of the industrialized world. It was dependent on money. So what has been done to prevent this from happening again? Well, we had a collapse of a French company, which had actually nothing to do with anything, but it caused a minor stock collapse a couple of months ago. And what happened was there was a trader, just an employee, and he was basically making billions of dollars in losses. The French company thought that they had to unwind their positions. As a result, $80 billion was sold off in one day. Almost all the stock markets in the world started going down 4 or 5%, which is a big move for one day. And our Federal Reserve chairman thought that, oh boy, this is the beginning of the big run. And he went out there and he lowered the interest rates by 0.5% in one day. I think it was 0.75%. Since then, he's lowered the interest rates over and over again. But that's not doing the job. Why is it not doing the job? Because it doesn't help the leverage ratio. If a bank only has lost $1 billion, it cannot loan $20 billion, and that tightens up credit for everybody. So what he did next, which was unique and I think brilliant, is the Federal Reserve chairman basically said, I will take $400 billion of these CDOs, of these subprime mortgage packaged securities, and I will allow that to be used as collateral to reflate your books and allow you to loan. That basically, $400 billion, by making that from a liability on your books, basically reducing your capital to just a footnote, I guess, basically frees up $8 trillion of potential loan amounts. And I think what we found in the last month or so is that the net amount of credit has actually improved a little bit, even though things are looking pretty bad. What's the next thing? The next thing that happened is all of the private equity firms that were affected, all of the investment banks that were affected, still haven't really come out there. They've shown and written off losses. They haven't shown and written off all the losses. So Bear Stearns basically came out last week, and they said, we're just about belly up. Now, Bear Stearns itself is not that important, but it's also a major stockbroker. So what would happen? There was a beginning of a run on not the bank, in this case, Bear Stearns, the investment bank, but on the stock brokerage. And of course, if there's a run on the stock brokerage, people are going to have to sell that stock, turn it into cash, and then put it somewhere else. So this was really threatening the entire financial system. So Bernanke, the Federal Reserve chief, he jumped in again, and he came up with a rescue of Bear Stearns. Basically said, I will take this investment bank and I will support with my Federal Reserve Bank the incredible amount of losses against this bank in order to preserve it as a vehicle for its stock brokerage. However, you have to sell your entire company for $2 billion, company that was valued at $170 billion. This deal was put together on a Friday. I think that was not last Friday, but the week before that. And that deal was put together. And then on the Monday, the investors woke up and said, my God, I bought stock at 17 times this amount or 38 times this amount, and I'm getting screwed. So basically what the Federal Reserve was doing was saving the accounts of the investors and then screwing the stockholders. So Merrill Lynch offered to, J.P. Morgan offered to buy it at $10 billion instead of $2 billion, but it had previously been valued at $170 billion. So there's still a lot of people losing a lot of money. My name is Reed Silverne. The name of this show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker.